Daolu Cai. I'll be speaking about the Asian economic impact of this health crisis. I will be speaking in particular the fiscal and monetary responses enacted by different governments. So the roadmap of today's presentation would be, I'm going to discuss briefly the nature of this recession, how this recession is very different from the previous recession that we have encountered. We're going to address the key concerns that we have in order to preserve and ensure a speedy recovery. And three, I'm going to discuss the aggressive monetary and fiscal response in the world, and in particular in Asia. We're going to ask what they do and what are the underlying risks of these policies. And finally, we'll be discussing the risk in terms of sovereign debt, sustainability, and inflation. The question we're going to ask is, can this aggressive spending and borrowing from all the governments lead to episodes of hyperinflation and systematic sovereign default? So let's start with the nature of this recession. How is this recession different from the previous recession? The damage caused by this current global pandemic is severe. To further contain the spread of the virus, countries have implemented a variety of social distancing measures, paralyzing most non-essential business activities, putting the world into a so-called the Great Lockdown. The Great Lockdown is effective at saving lives, but it's also quite expensive economically speaking. With recent data that we have, for instance, during the first quarter, China GDP shrunk by almost 7%. In the US, it shrunk by 3.5%. Same thing happened in Hong Kong and Singapore, where we posted negative GDP growth. The IMF, the International Monetary Fund, forecast for Asia 2019 will be no economic growth at all. Most advanced economies in the region will post negative growth, and Asian Pacific region is expected to have the lowest growth since the 1960s. So simply put, this is a massive recession. Each piece of evidence suggests that the damage caused by this pandemic is worse than we saw during the global financial crisis of 2009 and comparable to the Great Depression of 1929. But this recession is also different from the previous recessions along several dimensions. To begin with, we know the exact cause of this problem, unlike previous recessions. The global financial recession that we saw, if we were to draw some parallel between a doctor and a patient, the previous recession that we saw, it was like a patient with no visible symptoms. The current recession is like a horrible accident. We know what to do. Most economists argue that the financial crisis will take longer to recover. If we're being optimistic, this current recession, we can actually ensure speedy recovery. So what is also different about this recession is the great level of uncertainty over the duration. The duration and the severity of the economic contraction. Partly because it would depend on the nation's effort. And as a matter of fact, the collective effort from all the countries in making sure that there's no spread of the virus, making sure that there's no second wave, making sure that there's no third wave. We need to work all countries together. So historically, this type of recession, whenever we have a recession, most economic policy would be focusing on boosting aggregate demand. This is not the case. Now, what seems to be optimal is to hit the pause button. What do I mean by that? The current recession is caused by a health crisis. So in alignment with the public health objective, and that is to contain the spread of the virus, the optimal macroeconomic response here may be to cool down the economy immediately, rather than incentivizing businesses and people to work. We need to cool down the economy immediately, in alignment with the public health objective. So if we were to think about a stimulus package, it would be implemented into two phases. The first phase would be containment, and two would be recovery. To speak of a fiscal stimulus is almost like a misnomer. The current contraction is a natural consequence of needed containment and social distancing measures. This makes stimulating the economic activity undesirable in the immediate future. We have a question right now is, how long would this recession last? Would it last like the 10 years, like the Great Depression? So this is a great question. Let me address the question in two phases. Any prediction, and I will agree with our dean, any prediction here is premature. And let's talk about how deep the contraction is going to be. So can different sectors, so we need to answer the following question: how easy is for different sectors of the economy to adapt to the new normal? Can we retain the productivity level from working from home? Unfortunately, not all economies and households have the capacity of an opportunity. So that would be the first, the answer to your question is the first phase is how deep is that contraction? Different economies, depending on how advanced they are, will be able to mitigate this contraction. The second part of this recession will be, when do we see a partial rebound? So I would argue there will be two major factors in making sure that we have a partial rebound, and that is consumer confidence has to be restored. And how do we do that? The only way to do that is to make sure that there are no fears of additional wave of outbreak. And that would be out of the hand of the economists, and the health experts are addressing that in different countries. The second factor would be, our households, families are willing to resume to work, well, only if they feel safe that there is no second wave of outbreak. So that we see that as long as we can contain the spread of virus, we will be able to see a partial rebound as a natural consequence of relaxing all these social distancing measures. I think the important question here is, when do we see a full recovery? I think that is a very important question now to address. When shall we see a full recovery? In my opinion, there will be two fundamental questions that we need to address now. The first one is, how much of the industry will be destroyed and need to be relocated to new sectors under the new economy? That's the first one. The second, how much of capital would have to relocate to the new economy? The second issue that we need to address to make sure that we have the full recovery will be the financial crisis. Do we expect that all these aggressive monetary and fiscal policies is going to be followed by a financial crisis? Of course, I'm going to talk about that in a bit, but my suspicion here is that the crisis would not last as long as the Great Depression, and we have some approximation that would be the Spanish flu of the early century. It had the massive fatality rate, but the economy recovered within months. In this global pandemic, the first order issue is make sure that there's no first wave and second wave outbreak, so that consumer confidence are restored and the households are willing to work in a safe environment. And two, we need to make sure that all the macroeconomic policy here would not lead to a subsequent financial crisis. And we have some more questions about the purchasing of debt, how countries are monetizing their debt, and whether that would lead to inflationary effect in the future. That's a great question. So, let me hold on to that question. We go back to this question. This is a very important question. Let's talk about these two policies that all these economists implemented. I would address that question just in a bit. So how are these countries, how are the Asian economies in the world, America, Japan, Bank of England, we're addressing this health crisis? There are two fronts. The first one is fiscal policy, that is government spending. Many countries has provided cash handout to households and package to relief program for industries. So what's the idea of the fiscal policy here, I think the best way to think about this crisis is how to make sure that we can preserve the relationship between employers and workers. That is a valuable relationship that we should preserve during this transition. Make sure that this crisis will not destroy that match. Simultaneously, there will be valuable business-to-business relationships. So let me argue the case of Singapore. Singapore is quite remarkable, the fiscal policy announced by Singapore. So the virus hit us at last week of January, early February. Immediately, the government of Singapore announced that there will be 5 billion ready in the coming years to help business and households. And a lot of people wonder, why do we announce such a policy early on? That is within weeks of the outbreak of the first wave. And I'm going to make a case that this is a very effective policy for both public health and to set the expectation for recovery. By announcing that the government is going to step in and guarantee that there will be a package of $5 billion in the coming years to help businesses, it would help the business to preserve that relationship and to mitigate massive layoff and to mitigate massive bankruptcy. So to set the expectation early on, we can minimize layoff, and furthermore, we can reduce that uncertainty implied by this crisis. So that sort of policy is very effective, in particular for government that have high level of credibility. So what about the second set of policies, and that is monetary policy? What should the central banks do, and what are the central banks doing right now? Central banks need to make sure that we have sufficient liquidity. Remember, we need to preserve that business-to-business relationship. We need to make sure that business-to-workers relationship is preserved. So we need to make sure that there's enough liquidity in the market. For example, the Fed and Bank of Japan, and now the most central bank in Asia, they are to expand purchasing beyond government and corporate bonds. Why are central banks stepping in making such an aggressive move? Here, what the central banks are trying to send is a strong signal that they are here to be the lender of last resort. What do I mean by lender of last resort? Whenever you need funds for urgent needs, you will turn to someone, and you have exhausted all other options. So who's left? It will be the central bank. The Fed, the Bank of Japan, and a lot of central bank in Asia, they have stepped in and said, we're going to buy corporate bonds, we're going to buy even market index to make sure that I'm here to serve the role as the last resort. Let's go to this question. I'm going to pick up this question, which is a very nice question, and that is, shall we be worried about government spending and the fact that the central banks are absorbing all those debts? Shall we be worried that the central banks are lending money immediately to the government and therefore generating episodes of hyperinflation? So the potential issue here is that the Fed or the central bank or many banks in Asia Pacific, they have been buying a lot of government bonds. And that is the question that the audience is asking. And in a lot of ways, the balance sheet for the central bank is blowing up. The question is, hey, can we generate inflation? Bonds that are not absorbed by the market, they are being absorbed systematically by the central bank. And historically, and this is the case of Argentina and in other cases in Latin America, that seems to be a lethal combination, central bank financing debt. But I do not see that it will be a systematic risk of inflation in this case. There's two reasons to believe so. For inflation to happen, the treasury or the government, they need to default on the debt. So even though this is a massive spending that we're incurring, the market is charging a very low interest rate on that debt. So as long as the government have enough ability to tap adequate source of revenue in the future, I think the inflation risk is contained. I do not think that the market have the expectation this is a systematic operation that the central banks and the government are engaging. And again, if they were systematic, that would be a lethal combination, but this is a one-time shot. The government still need to pay back the debt. We will need to see future action. What matters here is the future action for the government to make sure that they have enough resources to pay the debt in the future. We have a question here. Do you think if we were to take measures in Latin America, releasing pension fund in certain countries would be ideal in the context of COVID-19? Let's try to address the concern here. We have an issue which is health crisis. Of course, there are a lot of needy families that need cash transfers. The best way to do so is the government step in and hand out cash transfers. I understand there's a case of, in the case of Latin America, there's issues where the most needy families, because there's a big informal sector in the economy, cash assistance may not reach to those families just because we do not have a good system of information. So some countries have tapped private pension funds, that's the pension system in most countries, to address the current cash flow. How do you think this is going to change the commercial relationship between countries and regions from now on? Along that dimension, I would say I'm optimistic, and partly because trade has to be the medicine for a speedy recovery. Given the supply chain, the current structure of the supply chain that is so complex, there are a lot of trade of intermediate input throughout the chain value. We need more trade, not less trade. So I would like to pose an example of medical equipment. So big countries that ban export of medical equipment are counterproductive in this environment. If we want a speedy recovery, if we want to address the health crisis immediately and efficiently, we need more trade, not less. So I think any tension in commercial relation between countries would be quite myopic. I'm optimistic. Let trade be the medicine we need for recovery, and let's not be an obstacle. I think that would answer that great question. Is what's the role of trade? Trade would be fundamental here. A lot of people are asking about how should we be worried that the central bank are buying a lot of debt? Well, I can talk about briefly that Japan is an emblematic example. The Central Bank of Japan have been purchasing a lot of treasury bonds in the past. And we do not see a systematic risk of inflation in the Japanese economy, but rather with deflationary pressure. So again, what matters here is not that the central bank is buying these bonds, but what is the ability that this government have in repayment of these bonds. Okay, I'm going to read this. Is quite a question. Would this trigger a third world war or social unrest coupled with potential food crisis? Most fiscal crisis stimuli seems to aim more at avoiding social unrest than increasing aggregate demand. That's a really good question. And again, because of the current crisis is induced by a health crisis, I'm not sure increasing aggregate demand or expanding would be an optimal solution in the immediate run. Of course, I understand the social unrest here that people are not able to work. This is an interesting statistic, and that is about a quarter of the US household populations are hands to mouth. What I mean by that is they're living paycheck to paycheck. That is quite difficult during this social distancing measure. People need to work. there's this tension here. The government, the great lockdown, but the houses say, I want to work, otherwise I do not have my income. Whether the current stimulus is enough on a country basis is a judgment call now, but I do not anticipate a potential food crisis, in particular because technology and science is in our favor. So I would be more optimistic along that dimension. Thank you very much for joining us. I had a lot of fun with you guys. Thank you very much for your questions from around the world. And remember, we're all in this together, and hopefully we can resume our life and plans very soon. Stay healthy, everyone. Thank you very much.